Hi, everyone. It's Larry McDonald with the Bear Traps Report here. We've got the team in New York and the team in Latin America today. Really excited. I've chosen Robert and Valentina today. We've got a much broader team in New York, but some big things are happening. I mean, the Fed is pounding their chest around more rate hikes, and we run an institutional chat behind us. Started in 2010. A lot of hedge funds, mutual funds, and pension funds are our clients in about 20 or so countries. But we wanted to give you kind of like a recap of what we've heard today in the chat. First, we keep hearing the last week that there's a long-only mutual fund, pension fund that's blowing up. And the losses in treasuries are spectacular. That's leaking over now. That credit risk is leaking over. I guess you say interest rate risk is now turning into credit risk in the banks. So the number of banks are off 5% today. The KRE is breaking a huge level. Real negative situation, which typically credit leads equities. High yields underperforming today. CMBS on the commercial real estate side. Jose, why don't you pull up that CMBS chart or the KRE and I want to bring in Robert Van Battenberg. Rob,
Right.
describe what you're seeing today in the chat, the conversations that you've had with the institutional accounts.
Well, we had, some talk about the averted shutdown. That actually raised expectations of an interest rate hike for the Federal Reserve by November back to 33%. So by the end of last week, they were down to 20% because the shutdown would basically prevent the Fed from hiking rates in November. So the surprise deal over the weekend jacked up those rates, odds down up to 33% again, which doesn't really make
And
sense.
real yields are now 233, 232 on
Right,
real
right.
yields. That's a new high, isn't it?
Right. Yeah. Well, to finish off with the rate hike expectations, it doesn't really make that much sense for the Fed to hike rates in November when they know that 15 days after the Federal Open Market Committee, there's another fight. There's another potential government shutdown, right? Because the deal that they struck over the weekend is only for 45 days, which means they have to come up with a new spending deal on November the 17th. So these rate hike odds seems really out of place. Now, on the long end, yes, yields got more unhinged. Powell was talking this morning. He talked on Friday already. He didn't mention monetary policy then. He didn't mention monetary policy this morning as well. He had the opportunity to put some control over the long end. He didn't do that. So when market vigilantes in the bond market started to essentially get a hold of or get visibility about whether Powell should say anything about monetary policy, they realized that he wasn't going to. Then they took yields up to 4.7%. And that's where we are. That's where we went. And now yields are backing off a little bit. What was interesting is that Barr, who is also an important voice on the Federal Open Market Committee, just came out and said that basically they're not going to raise rates anymore. So, using his exact words, likely we are or very close to sufficient restriction. So I think in the end of the day, the Fed may start to worry a little bit about where rates are headed. There's a lot of people in the chat that are flabbergasted by, how the Fed can stay so hawkish up here, driving up the dollar again, while most other central banks have basically made a dovish pivot, right? We've seen the Bank of England not raise rates last month. They're faced with a steep slowdown in the United Kingdom. We've seen the European Central Bank basically making a dovish hike by the middle of September. Not likely to raise rates anymore. Brazil is cutting. Chile is cutting. Uruguay is cutting. RBA, they're going to speak tonight, but it's very likely they're not
Australia.
going to. Yeah, Royal Bank of Australia is not raising rates anymore. They're past that point already, and
But
the
Rob, let's
Fed
bring
is
it
the only
back to
game
the
in town.
market. Let's bring it back to the market today, okay? So
Well, so in the wake of the long end getting unhinged, you see utilities falling out of bed, right? They're basically
no,
treasuries
but
in
not just
disguise.
falling out of bed. No, this is probably the worst day in maybe 10 years. We're talking 5.5, 6%.
All right, so you're seeing utilities getting clobbered, right?
Now 25, 26% off the highs.
It's
It's
very unusual to see utilities the worst performing sector in the market, right? That rarely happens. Utilities are very defensive. This is not the kind of environment that is where defenses are underperforming. We've seen pharma acting really well in this kind of environment because it's also a defensive group, but people are getting really, really terrified about defensive sectors that are exposed to interest rates. Utilities are interest rate sensitive sector because people who buy utilities are buying it for a dividend. So if yields on the risk-free rate, which is the treasury, are going up, then yields on utilities and REITs, real estate investment trusts, have to go up as well. That means that the yields go up, the prices go down. So that's what you're seeing here. We see massive puke on utilities now. You've seen real estate
but
investment trusts
but
have also
Rob,
been
yes,
clobbered.
yeah. So Jose, can you put up the CMBS chart? CMBS. One of the things that clients are talking about in the chat today is Bank of America. There's two institutions in the chat that think Bank of America could be mortally wounded because of their holdings of mortgage-backed securities, commercial real estate, treasuries. Remember, after Lehman, the Fed forced the banks to hold more mortgage-backed securities and treasuries. So you're talking about in the treasury market, there's bonds that are down 20, 30, 50 points. And in the commercial real estate market, as you can see here, making new lows today. Credit typically leads equities. When credit's really weak, when interest rate risk comes into credit risk, that typically is an indicator that the Nasdaq's going to follow credit here. In other words, credit most likely leads equities weaker, and then that pulls the Nasdaq down. Bank of America, Rob, trading at 0.8 times book, and JP Morgan at 1.5 times book. So the drawdown for JP Morgan is only 11% off the high. Bank of America, 45 almost percent off the high. That's a divergence that you see once or twice in your life, okay? You saw it in '08. It's something that's very unusual. And people in the chat think that, Jamie's out there pounding the table today. He's saying some very weird things in some ways, around like, oh, we can withstand a much higher Fed funds rate. But, the rest question is, can the banking industry and the regionals, it almost looks like some people are saying in the chat, institutions are telling us that it looks like Jamie, is kind of, wants to go on another shopping spree here. In other words, would like a little pain, another round of victims in the regional bank side to maybe scoop some assets up. Rob, you with me?
Yeah. Yeah, well,
What did
JP
Jamie say
Morgan,
today?
he says the Fed funds rate are going to 7%. So he's been saying that for a while. JP Morgan is, of course, a big asset gatherer, but, they've also taken advantage of the shakedown in regional banks in March of this year. But there's also a discrepancy in banking land in the United States between the big banks and the smaller banks, whereby the big banks take advantage of the net interest income margin that continues to go up with the Fed funds rate and the yield in the market. So if the yield goes up, then the banks, of course, can deploy all that money that is sitting in deposits at a higher rate, and they only pay their depositors maybe a fraction of that. So the deposit beta that they call it is very low for the big banks. So they're keeping the rate that they pay their depositors on savings very little, but all these trillions of dollars that are sitting in deposits, they can put them in the market, money market funds or whatever, and they can generate a higher yield on that. So they're making a lot of money on this interest rate environment on the one hand. On the other hand, they're incurring losses in their credit book and in their fixed income book because the prices of these bonds are going down. So it's a double-edged sword. But For the smaller banks, their deposit beta is much higher, so the depositors demand a much higher interest yield on their savings if the yields in the market go up. In other words, the smaller banks do not have that luxury of capturing this fat net interest margin. They will have to raise the interest rate that they pay the depositors on their savings. So that's why the smaller banks have underperformed so much this year. Um, and I think that will continue to play out.
Yeah,
That's
that's going to
probably
break the
not the
Fed.
only reason.
That's going to break the Fed. Let's get into the reality of the situation. So the Fed is going to break something. All measures point to, rising stress, financial conditions on the consumer side. You've got the banks are down 45, but now, American Express down 24, 25% off the highs, down 17% in 8 weeks. I mean, this is clearly going. Look at Capital One, Discover. You're talking about these stocks that face consumers that are down 40, 45% in the case of Capital One facing, and you had Citigroup coming out today talking
But
about.
guys, what does this actually mean for the market?
Okay, so for the market, when the small when credit card when credit card companies and banks underperform, that's a classic leading indicator for the market because you want to be very careful when high yield or credit risk starts to rise on the consumer level and at the bank level and at the commercial real estate level. That typically can really run up very fast into the market, and that's so when you see American Express dramatically underperforming the S&P, that typically, looking back 20, 30 years, that's not a good thing. Speaking of leading indicators, Jose, I sent you a text. Please put up the transports charts, TRANS.
Guys, so overall, what do you think about this? What's going on? What's going to happen within the next 5 to 10 days?
Okay, so clearly today, this is the most dramatic underperformance for the banks, utilities that we've seen in a while. So the banks across the board, there's a lot of pain, and high yield is starting to crack a little bit. So to me, it looks like equity vol, so stock market, the VIX, looks cheap relative to what's happening with the banks, with commercial real estate, with rates. I mean, there's something happening in rates where 10-year treasuries, 30-year treasuries, somebody's blowing up. Okay, I don't know if it's a pension fund, I don't know if it's a mutual fund. That typically will lead to further contagion over the week ahead. It could calm down, but the moves are so violent. And the transports are dramatically underperforming here, which is another very, very. So right now the drawdown in the transports has reached 19%. I just pulled it up. So close to 19% from an intraday high in 2021. But you've got a lot of pain in the transports. You could see there a really nasty move down. And Buffett always said, transports don't lie. I mean, because they're the classic leading indicator for rails, airlines. They're much more economically sensitive. Transports don't lie. When transports start underperforming with the banks underperforming, with high yield that's starting to underperform, those three things point to the index as a whole having a problem. But thanks for joining us. It's the Bear Trap Support. We work with institutions in 23 countries. Valentina, Sanchez, Robert Van Battenberg. Great to have you guys join us today.
Thank you. Thank you. Bye.
Bye.